Hi, I'm Keith McCullough. I'm back with our tech all-star, Craig Berger, to talk about the semi-stocks sector that we were signaling as bearish from both a SOX and an SMH perspective earlier in the week. And Craig had some thoughts in the morning meeting today on Atmel and what it might mean for the sector.
Thanks, Keith. So Atmel, ticker ATML, reported results last night. It is a smaller company. They make little microcontroller chips for industrial applications, memory chips, and touchscreen control chips. Really, we use it as a signpost for the sector because they do have their own manufacturing facilities and have been in the semi sector for a long time. So in short, what we saw last night was additional signs of upcycle frothiness in the chip sector. Momentum metrics are peaking. Chip firms are likely shipping at above end consumption rates. And upcycle goodness now means that you're going to have an eventual down cycle reset, which we think is increasingly likely into early 2015. So in terms of the four signs of semi upcycle frothiness that we saw last night from Atmel, first, Atmel's lead times are up. Secondly, their foundry capacity is getting tighter. They have internal fabs, but they also use foundries, and their foundry capacity is getting tighter. Third, their own internal fab utilization rates are well above 90%, which means incremental ability to support internal revenue growth and limited fab utilization benefits from here. And then lastly, memory shipments grew 13% sequential in Q2, and we're guided to grow another double digits or better in the third quarter. In the 13 years that we've been tracking Atmel, we have never seen memory grow double digits sequentially 2 quarters in a row. So that would be a first. It almost happened in 2009, but didn't quite get there. And so with this level of upcycle frothiness in the sector, we see some defensive names to own if you have to own chip stocks, and we see at-risk names.
Now, when you think of the at-risk names, and do you think of it as companies saying it's going to be different this time? So in other words, Atmel's guiding to something they've never done before. Is that how you're identifying who's got the most risk, or are you looking at the actual stocks and levels, or both?
It's more the latter. It's which stocks have already seen some partial reset, which stocks are down off their peaks. Those are somewhat de-risked a little bit. We look at things like how defensible is the business and what are the gross margin levels.
Right.
Companies that are more commodity-like with lower gross margins have historically seen faster or steeper price declines in the stock. So we look at beta, we look at defensibility of the model, we look at the chart and the levels and how much air is already been let
So if
out.
you look at something like Atmel today, I'm looking at this, I mean, this thing's actually, it's not a huge market cap stock, but it's trading down 8%. And again, that's what I guess you're trying to identify on the negative side or the at-risk side, is somebody who's coming off something that's close to peak utilization, peak margins, with aggressive guidance.
Yeah, I mean, I don't think their guidance is that aggressive, but absolutely momentum metrics are peaking, and it's hard to see how it gets better from here.
Yep.
Usually Q4 is a flattish kind of quarter, and Q1 is sequentially down. But if the chip guys are shipping at above consumption rates, you could have a more drastic reset with Q1 guidance in January, or even potentially before that. And Atmel is one of those stocks. It's expensive on earnings. It's not as expensive on a price to sales basis. So maybe there's not as much downside left at this point versus some of the stocks that are still at their highs. But clearly for Atmel, I mean, if there is an estimate reset, easy downside to $7 if things get worse.
And you've talked, I mean, earlier in the week we talked about the risk to AMD's numbers. We talked about the risk to AMD's stock. What other at-risk stocks do you have on your list?
Right, so AMD is one of those high beta at-risk stocks, and they don't have much cash and they have a lot of debt, so that makes it a little more worrisome during a down cycle. Other high beta stocks would include Fairchild, ticker FCS, and ONNN, ticker ONNN. You've got high flyers that some of them have come down a little bit, but others not as much. Guys like Synaptics, SYNA, or NXPI. And then finally,
some of these, like NXPI, has been just a balloon. I mean, these stocks have been huge stocks.
It's been huge, and it's been fueled by buybacks. And NXPI has a large debt position, but they're still doing big buybacks.
Right. But I mean, the greater point here for people who are looking at the early cycle indicator that is the SOX rolling over is the cycle rolling over. So if there's not a lot of room, for these stocks, is what you're saying, if in fact that is the call. You're not completely sure that's the call, but the risk is rising.
That's right. And it's not going to be a disastrous reset. I mean, we're not talking late 2008 or anything. It's just that this overheating has to normalize for the chip guys. And so that could be a 10 to 15% revenue reset in any given particular quarter, and then you start to recover from there. But it definitely would hurt to some degree.
Now, just to wrap up, just for, because we have a lot of customers obviously who have to be long only stuff, people are long and short stuff. What do you think are the more defensive names to have on the long side in the face of all this?
Right, so defensive names to me are guys with fantastic business models, inexpensive on earnings power, and or stocks that have already come off their peak to some degree. So Qualcomm, it's a little bit hairy, but it seems to be settling out in the $70 to $73 range. I think that's a great name to own. Maxim is a good place to hide out. They've got a 4% dividend yield and a rock solid business model. Linear Tech in that same camp. And then one last name, Silicon Labs, ticker SLAB. It's a smaller growth stock. It's trimmed about 22, 23% off its enterprise value, and it's starting to try to work higher again.
Yeah, all these, again, that's the point. If it's already blown up, it's easier to say it's more defensive.
Exactly.
But this sector is seeing some blow-ups, and again, that's the point of today's video. Atmel's having its own little blow-up this morning. So again, you want to watch what's happening here, not only because Craig thinks it matters, but it also matters within the broader context of the S&P 500's early cycle slowdown message. So again, that's how I think about it. I'm at Keith McCullough. You can find me there on Twitter, and you can find Craig at Hedgeye Berger is his Twitter handle.